Hello YouTube. In 2017 forecast, trucking industry expected to grow by 5.5% each year until 2022. So today we all know what's happened later. So this video comes a little bit late. I've been planning to make this video back in December 2022. However, it got late and now finally got time to get it done and record and publish. So this video presents a trucking industry forecast like overview of 2022, then through forecast to 2023 and beyond. We will look at the points like trucking industry, historic revenue trends, trucking industry versus S&P 500. How did we perform? What influenced that? How well 22 end, though it's already end. What to expect in 2023, the market trends versus rate per mile, and as I promised, beyond that. So the trucking industry, 21-year revenue from 2001 through 2021 shows us an interesting chart here. This is how the trucking industry were performing in terms of revenue according to national statistics. So here what we had back in 2001 and 2002, where there was a dot-com crisis, then of course 9/11. Here we had market rollback, compared to the previous years, and then market started regaining slowly and finally started growing in 2023, 2024, 2025. Interesting thing here in 2004 is a presidential election year, and then we see next 2008 year, next election, then 2012, 2016 and 2020. Interesting thing here is that if we look at 2004, the market were growing from the year before election and the year after election. Then the next thing in 2008, we know that financial crisis occurred, and it was the same year the presidential election, and the next year were terrible at the market were on the downside. But since then it's been growing steadily until right until 2019. And then if we look at the next presidential election back in 2012, we see that the 2012 were pretty much similar as 2004. We had growth before presidential election year and after year, and the year after that. And a little bit quite a similar thing as back in 2016, where we had more or less similar picture here. And again, we had same thing in 2020. So this makes year 2023 looks to me somewhat positive, because I expect it to be better than 2022. Let's go further. Now here we have to look at, I just want to say that the trucking industry in general from 2001 through 2021, in these 20 years, 21 years whatsoever, has demonstrated a steady growth in spite of different situations, like a crisis, like for example, as I said earlier, .com, 9/11, I don't know why I'm saying 2011, then financial crisis, then of course China-US trade war back in 2019, where we had a major fallback in the industry, and then that terrific growth in 2020 through 2021, where the 2021 ended up as overconsumption. If you can compare this thing here, the top of the 2021, how it's overperformed the all years before that in terms of growth. And this is something really enormous, and that could have told us earlier that this will end up, bet in the year after that, maybe, like it's ended up in 2022, could ended up that way in 2023, but it happened in 2022. This is well expected, you know. And let's go farther ahead to another slide. So here I will, you know, attempt to compare. I don't know if someone else done that before, but let's try to compare tracking industry performance versus S&P 500 and SPRD S&P 500. Tracking industry versus Wall Street, basically. The Standards & Poor's S&P 500, or simply S&P 500, is a stock market index tracking the stock performance of 500 large companies listed on stock exchanges in the United States. And these are a bunch of companies here, and of course more than this. But you all know them quite well, you know, and most of us, we hold goods to those companies or for those companies, you know, and we'll be continuing doing that. So the tracking industry historic revenue trends, tracking industry versus S&P 500, what influenced that, how will 22 end, what to expect in 2023, market trends versus rate per mile. Here is the chart that I made, and I purposely downgraded these figures here because otherwise the chart could be, you know, too tall. Compared to one another, but those figures in terms of percentage difference between them are correct, at least according to a source. So the year-over-year performance tracking revenue versus S&P 500 versus SPRD S&P 500. SPRD S&P 500 is a index that with the companies less rich than S&P 500. As per best of my knowledge, but anyways, that altogether makes, you know, a great market. And the tracking industry here outlined in the blue lane here, whereas the SPDR S&P 500 is an orange lane, and the gray lane is S&P 500. And we can see here that the tracking industry pretty much, you know, aligned with this growths and degrowths, you know, fallbacks and growths and everything with S&P 500. And more or less it's been moving in the same trends. And if we look here in 2021, where the growth were terrific and for all three things, you know, like S&P and tracking industry, and then all of them fall down. So pretty much it's a comparable. And it may help us, you know, to predict future of tracking industry based on the prediction of stocks market, and which means that if stocks market performs well, the tracking industry most probably will do same, unless you know you will look into only a stock of tech companies, you know, where tracking industry not holding the goods for them, maybe like for example maybe Google, we can say Facebook. Those are software companies that not involved in into a direct sales, like Amazon, for example. Yeah. So this pretty much are useful chart, and as I said, it helps us predict a future because, you know, the tracking industry moves behind the market. If market's begin falling down, I mean the Wall Street market, a tracking industry may still do well and may start falling down like 3 months after that, after the Wall Street. And, you know, which means that if we are observing something strange happening, like, you know, if market is falling and, you know, market is becoming bearish, it means that the tracking industry in near future may follow. Let's go to the next slide. So what influenced that? The organic versus micro reasons. Let's look into this closely. The organic influence, the first thing here on the market, I mean the tracking industry, what happened in 2022 versus 2021 is that the first thing is reduction in consumer overconsumption, because 2021 consumers were simply over-consuming. This is why we got that boom. The second thing is a reduction in over-fulfillment, which means that when the consumers is over-consuming, overbuying, the warehouses, ports, and everything, they are working to refill their stocks, which means that the trucks are moving back and forth, back and forth. Consumers buying. Stocks in the warehouses are falling down, and truckers are replenishing those stocks. And that back and forth until it's all collapse. So what we got in 2022 is the less demand. Why? Because of the back to normal life after the COVID, no lockdown anymore, no stimulus money, which means that demand returned back to normal, but in reality, it's not just returned back to normal. It's actually fall below normal lane. It's why we got the market slash from compared to 2021 demand indicators around 20 to 30%. Yeah, so I think it's clear. I hope it's clear here. If we just assume that there is a line in between, and whatever on top is overconsumption, and whatever is beyond is underconsumption. So the 2022 compared to 2021 were fall from overconsumption through the normal consumption to underconsumption. That's why we got so many problems in the industry, the low rates. So many companies went out of business because there was, when the market were over-consuming, of course there was, the market were adding additional companies every day, and when that started falling, it means that market were now more requiring those companies and started offering less money for hauling the goods, and of course companies started actually leaving the market. And I think the last year we lost around 30%, maybe even more companies out of business. Next slide is macro influence. And macro influence here says us that what we had on the macro level, macroeconomic level, which is we had here issues with green energy temporary fiasco, because of the fossil resources and fuel crisis. When before there was a balance, green energy were growing steadily, moving out or driving out slowly a fossil resources and the fuel. But when the real fuel crisis happened, we realized that there is the time for green energy is not yet there, and we still heavily depend on a fossil resources, and that influenced industry tremendously. And we know that because of the fuel prices first of all, and shortage in supply in some areas throughout some time of the year. Then the next thing is the overall inflation over 30%. Throughout 2020 through 2021 and 2022, and that resulted in Fed interest rate increase because they had to actually counter the inflation, because when inflation becomes wild, it means that whatever we earn, for that money we can buy less and less things, and of course government have to do something with that, and Federal Reserve is one of the first leverages where that can be taken under somewhat control. It cannot be fully controlled, of course. I think that's not enough, but anyways, it helps. It helped at least back in 70s, back in 80s, and this time, no surprise, Fed used the same tactics. So they started increasing the interest rate to actually slow down business activity by under-stimulating the borrowing, yeah. So the war and the overall political unrest, all that resulted, plus another factors resulted in uncertainty. And uncertainty is the thing that hits the consumption or consumer power the most, because people are becoming, uncertain. They're uncertain about tomorrow, and they start, saving more money rather than spending money on unnecessary goods. And of course, when they are spending less, it means that we are hauling less. The market demands spending power. Next slide. How will 2022 end? As I said, that's late video, and anyways, I decided to put this thing into this video. So the result of 2022 combined effect on the market demand 2022 trucking market 2021 100% size has been dropped from the point of 100% in 2021, 15% in organic reduction, and 15% in macro influence reduction. Those things that I discussed in the slides before. So the approximately 30% of the total combined downfall in 2022 versus 2021. Then what we can see here on the slide to the right, I'm sorry for my voice, it's a reduction from $520 billion in consumption to actually in trucking industry, I mean, to 411 billion dollars, which is dramatic drop of around 25%. And which is close to, very much close or similar to 2018, which is used to be good comparably just as a year before 2019, the year that was terrible for trucking industry. And of course, this year we feel in 2022 we didn't feel as good as in 2018 because money became cheaper. Whatever we were earning, and because of the expensive fuel, though we've been still like earning similar or more or less similar to 2018, we didn't feel that because everything were very much expensive compared to 2018. Money were cheaper, fuel expensive, repairs expensive, equipment expensive, all those things are way more expensive compared to 2018. So of course that became unprofitable to us. So the next slide, what to expect in 2023, market trends versus rate per mile. So here I wanted to look first at the left side of the screen at 2023 motto is stabilization. This is what I personally expect from 2023, and I believe it may happen unless we get some new impact. We had war, we had pandemic, I don't know what this time, the politicians will, make us happier. I don't know, but we'll see. I hope, nothing similar to that will happen, and this year I call a year of stabilization. So the historical similarities with whatever we had back in 2022 may be actually taken from 70s, 80s market crash, or comparable to that. The fuel crisis that we had back then, and the gas shortage, though we never had the same, terrible things back in 2022, like, complete fuel outage, or something close to that. At least fuel were available. It were expensive, but at least it were available. Then Vietnam War back in that time, the parallels with Ukraine War, but without U.S. involvement this time, I mean direct involvement. Then the great inflation, and we have really great inflation we had, in 2022, 2021. Then the high Fed rates, are coming back. We know that from 2022, and we don't know what to expect in 2023. Whether Fed will continue increasing that or they will stabilize at that level. So market can get used to that, and business will start, borrowing that money more actively because there is no other choice. Then uncertainty, of course, that all creates an uncertainty for business, for a general public, and for trackers as well, for anyone. And in general, that situation doesn't, help to the market growth. Now, in the span of 10 years, but especially in 73, 74, the crises were very terrible. What do we have to stabilize 2023 compared to 70s? Well, we got credit cards, though they are maybe more expensive right now, but they are available. Back then, there was less spending tools. And a greater population, of course, is what we have compared to 70s. Greater population, more spendings, more demand. The second is not as bad energy crisis, like back in 73, 74. No direct involvement in war, again, as I mentioned earlier. European manufacturers, this is very important, because of that war in Ukraine, European manufacturers and capitals are moving to the US because of the very high fuel prices, energy prices over there, like gas specifically, because many productions in Europe, the factories, the plants, they are still operating on the gas. And if gas is expensive, you cannot compete with the rest of the world, especially China, and the Asia as a whole, the other countries, the other parts of the world, including US. Mexico, Latin America, whatever you say. And it's they positively influence U.S. because those companies, those businesses are moving out of Europe and they are looking for a safe haven, and U.S. always been a safe haven because of its policies, because of its opportunities, and because of its stability and financial guarantees compared to the other world. So the fifth thing is that the selling expensive oil and gas to the European market. Of course, US are gaining lots of money right now, and that industry is booming specifically. The oil and gas industry. Then we know the other resources, uranium, maybe. The crops and everything else, whatever required for our basic needs, and for energy, for the food, those are expensive right now, and those are help to actually make lots of money. So whatever, and there is a general rule in the market because market has actually a limited amount of money. If one side of the market falls short, it means that on the other side of the market, it means that this money that falls short in that side of the market are moving actually to the other side of the market. And we can see that clearly from the S&P 500 charts that the tech companies, those are unnecessary things like the things that can be still substituted or not so important to our life to actually suffice our basic needs like food, like electricity, water, and blah blah blah, like fuel. So those industries fell down, but the industries that actually help us to fulfill our basic needs are expensive right now, and they are highly successful right now, and that industries are having no problem right now, and they are earning those money that they've been losing since 2015, and it's actually the fair rule or rule of thumb, I don't know whatever call it, lots of industries been losing money throughout like span of 6 years. Now they are regaining whatever they've been losing that time, and now is the time to lose for those companies that have been gaining throughout that period. Okay, it's actually pretty fair. And next thing, will it get any worse? Well, it's likely if we run out of fuel like back in 70s. This looks to me like unlikely, but who knows what to expect, because we know that there is a presidential election next year, we don't know how political fight will go and what external forces how influence that. We know that there is a war between Russia and Ukraine, and how Russia, I don't know, whatever the oil countries together may do actually. We don't know. But let's see. But you never know, something may happen. Some plant may blow out, or something else, and then there may become either organic or artificial shortage on the market. But anyways, I look positive into this year. We'll see though. Inflation is not over yet, and the risk of recession is still high. Yeah, we'll see what will happen, but again, as I said, depends on the Federal Reserve. If they will stop increasing the borrowing rates, then it means that the market business especially will get used to it probably, and there will be more of activities on the market, more investments and everything. So what I expect in a snapshot from 2023 is modest growth. It will be better than 2022. Then the average retail price per gallon for fuel will be around $4 before discounts. With discounts, I think it will be around maybe $3. Maybe a little above that, sometimes maybe below that, but I think it'll be around maybe $3.1 after discount. Depends what fuel card you have, of course. Can be in 3.5 and can be more, depends on state and everything. I'm saying about average. So then the average rate per mile, I expect like something similar to 2018, 2019, but I think the 2018, which is better part of that time in the market, but with correction to inflation. So for dry van, if $2.27 were a good rate back in that time, it means that the same rate at this market, at the current market, will be 2.72 with correction to inflation, because money are cost less now. So the somewhat fair value of that money today, whatever was 2.27 back then, is now 2.72. And for reefer is 251 then and 3.01 in 2023. The flatbed 253 and 304 in 2023. We'll see though, but that's my prediction. Then let's go and look here. Yeah, as I explained, money became cheaper because of the inflation. Cheaper money than ever before. Next slide is to actually, how does the US recover in the past? Let's look, this is pretty much interesting. If we look like back in 1957, when there was a market issue, the market fall down 14.3%, but very next year it's regained its growth on 38.1%. The worst years were 73 and 74, when market first fall 17%, and then next year even further it's fall down almost 30%. The next periods after that, in 2002, then 1974. Oh, 1974, sorry. Yeah, 1974, of course, it's there because 1974 and 1975 compared to it were way better. Yeah, after 1974, we had growth of 31.6% compared to the year before. And in 2022, again, 2022 fell back 23%, and then next year growth 26%. Then 2008 financial crisis, market fell down 28.5%, but next year it's grown 23.5%. Means it's regained. How much is that? Around like 75% of whatever it lost the year before. And it's good. It's good sign actually. That it means that 4 times out of 5 times next year will be way better than the year before. And I pretty much, not just hope, but based on the indicators, I just, think that this year will be better. So 73 to 74 was the worst since mid-50s past century. Now let's look here. Oh, let me go back. So let's look here. This is very interesting thing. Federal Reserve interest rate fluctuation chart. Here over the years, since 50s or 60s, we can actually see that the Federal Reserve were increasing rates and decreasing rates based on the economic situation. So back in 70s, a fuel crisis here, we can see that the interest rate, because of the inflation, high inflation, and fuel were unavailable for some time, market were, in a terrible condition. Of course, first they decreased, then when the inflation happened, they increased the interest rate to kill inflation, and then they started decreasing that to actually stimulate business to borrow money, and do business activities around to create more jobs, to get out of that crisis. Then there was wild inflation back in the 80s because of the tech boom, the printers, scanners, all that things came out, and the process. You were not needed anymore just to make calls, you had more tools to do your business, and of course business became way more faster, and that had its cost, it's actually ended up in wild inflation. And to fight that again, the Fed were increasing the rates to fight back that inflation. And then, mid 80s, the rates started falling down slowly, with up and down, up and down. And then I'm not pretty much sure, what happened back in 90s, but here we had, the quite low rate. It means that there was some crisis. I'm not sure what crisis, because when rate reduce, it means that Federal Reserve actually trying to help market, trying to stimulate business, to borrow money, and do business as much as possible, to grow economy. To stop recession, to fight recession, create more jobs. And then probably another wave of inflation, rates again been increased, and then dot-com crisis, the other crisis of 2000, 2002, and rates went down again to stimulate the market. Then started growing again because of inflation, some other factors, and financial crisis, 2008. And again, rates fall, are super down almost to like 1%, maybe, I don't know, 1-2%, to stimulate, how terrible situation were that time. And of course, Federal Reserve were making, money available for as cheap as possible, so business will borrow that money. Business could borrow that money, people could borrow that money, to stimulate consumers' power to make credit cards cheaper, to make loans cheaper and everything, but, take money and do business, please, to take us out of recession, create more jobs and everything else. Then trade war with China. Another wave of inflation, and of course Fed Reserve increase. And we remember how that influenced on the trucking industry, what influence it had on the trucking industry. Back then, goods were not available to haul, and inflation were high because of that, and again, Federal Reserve money were expensive. So we had terrible days, terrible time. And then pandemic, I call it Resident Evil, but it's pandemic, yeah, and Resident Evil because of the game that I used to love before a lot and play a lot about the virus and zombies. So here, when that occurred, of course, business were completely down. You all remember that, and of course, money made super cheap by Federal Reserve again to stimulate economy, stimulate business. People, please take money. Let's move forward. And now, because of the inflation in 2022, we know that Federal Reserve started increasing, and that increase were way high than compared to 2019. It's almost double from that indicators, like 5%. That time it used to be around maybe 2.5, 3%, I don't know, but it looks on the chart, at least a half more. So the high Fed interest rates fight inflation by reducing borrowing stimulation. Low interest rate fight recession stimulating borrowing. I hope it's clear. Then the second thing, it's consumption fluctuation. Let's look into this closely to understand, a trucking industry here, the influence in trucking industry here, and what to expect. And all of us have to understand that in order to figure out what to expect, what to expect in future from the trucking industry, how to predict what may happen next year. If we look here in 2021, compared to 2019, 2014, 17, the market were steadily growing. The consumption demand were steadily growing, blah blah blah, because of the population growth, because of steady inflation and everything. And these figures are just example. They are not accurate. I just put them, for the purpose of creating this chart. And then here in 2021, what happened is that the market, because of the factors outlined earlier, linked to COVID, the stimulus checks, the lockdowns and everything, the people started consuming, and we ended up in the overconsumption market. So this orange lane compared to the normal, to the real consumption, to the real needs of the people. So people started over-consuming. Of course, lots of trucking companies, owner-operators and everything started entering market in order to actually haul that goods and make some money, actually good money. And we had driver shortage and everything, shortage. And then in 2022, it started falling down. And another paradox is that if it's in 2022, it was overconsumption, then in 2022 it was actually underconsumption compared to the real consumption needs. Okay, the underconsumption because people returned back to jobs. There was no stimulus check anymore. People, spent so much in the past year that they were not willing to spend anymore. And of course that uncertainty that were there, and everything. So the year resulted in underconsumption and industry dropped around 30%. Many companies were out of business, of course. So this year I expect a stabilization and growth of the market towards a real consumption levels, to the normal consumption levels. And which is good. It means that we will be, slowly, gradually, going out of this bad crisis in trucking industry. So the number 3 factor, which is very important for our future, is Biden's infrastructure law, which is actually being signed, I think, back in November. First, it's been a bill and project, and then finally turned into law, at least partly. That will make that directed to make the U.S. Competitive again, especially against China. Tons of new projects throughout a decade with trillions in spending. It means that new bridges, new cables, new internet, new roads, public transportation, and many things that actually country required to renew or build from the scratch in order to become a competitive for the years to come. And this is very important, and this is very expensive, and that requires lots of goods to be hauled, back and forth around the whole country. I really hope on that project, frankly speaking. Then the market growth 2021 through 2031. What I expect is that the trucking industry will continue growing, and compared to the past decade from like 2011 through 2021, a market from 2021 or 2022, say, through to 2031 will grow 50% more compared to that past decade. And that expectations of mine based on the inflation, cheaper money, then economic growth, population growth, consumption growth, and some, of course, tons of other factors. Population growth, of course, because of the organic population growth and because of immigration. Then the consumption growth, of course, the bigger population, bigger consumption. And that stimulates economic growth and infrastructure project, and those European companies that move in here. All that actually stimulates the growth, and of course I hope that the Fed will also help us with that, and at least won't increase borrowing rates further. At least if it will stay in that level more or less, it'll be okay, or if it goes down a bit, it will continue stimulating the economic growth. Well, I hope I didn't miss something, and I hope this video will be, helpful to somebody. Really appreciate, and let's keep in touch. I'm myself owner-operator, and my authority called Oxyana LLC. Thanks for watching. At Oxyana, I strive to support the industry and owner-operators, small trucking companies, as much as I can. Thanks for watching. And if you can put some like, maybe subscribe, who knows. Thank you so much for that. I appreciate it. And let's have a wonderful year ahead. Thanks.